Timing is really what matters, right? It's like you want to be pre-narrative. But of course, in life, we try to go up the hill.
But there was something you mentioned earlier when you were talking about fear of missing out and all that I don't think I've heard before.
When you hear very overly coherent narratives, I think that's a big thing for me. For example, defense is another one. We have, for the first time, startups building missiles. These are typically not venture-backable businesses, or not businesses that have venture scale returns. Because what you want to see in a venture company, right, which is you're looking for huge outliers, is you want to see.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Welcome back, Superclusters fans, and today is the episode you didn't know you needed. Albert Azout is the co-founder and managing partner of Level Ventures, a next-generation fund of funds built on the backbones of software and data science, and has invested in great funds like Pear Street Capital, Emergent Ventures, and Workbench, just to name a few. And oh man, you're gonna love how nerdy we get. Truly one of a kind of an episode where we talk about how to underwrite a fund manager's network in ways you've not thought about before. So prior to Level, Albert has been a serial founder, starting analytics businesses, and even a social media company before Facebook from back in college, or should I call it Meta these days. He's also spent time allocating at a family office and on Wall Street prior to venture, culminating it all into today. So if you're curious about applying neural networks to physical relationship-based networks, and what are the 3 things Albert looks at before investing in a GP, and game theory is one of them. So just a teaser there, as well as how the narrative around investing in defense tech just doesn't make sense today. The man sitting in front of me today, in front of you today, will answer them all. Albert, I know we've done a ton of scheduling Jenga for this as well, and has been a long time in the making, but I am so damn excited. So welcome to the show.
Thank you for having me. Yes, we finally got it done. So excited to talk today.
There is something really interesting, and I think a lot of our audience know that I like starting from kind of non-obvious places, but maybe if we could start somewhere. For those unfamiliar with the, let's say, finer nuances of gradient descent and gradient ascent in logistic regression, and so we don't start necessarily with Klingon per se at the beginning of this conversation, could you share the inception of the name of your blog, Gradient Ascent?
Yeah, it was meant to be initially a machine learning blog, an AI blog, and really and this was a while ago, just looking at the intersection of sort of real world applications in AI and some of the innovation. And that was before, obviously there was a big AI wave. Now it's hard to keep track of all the research that's coming out. But one of the key things, obviously, in these large scale neural networks is gradient descent, which is stochastic gradient descent. And you're essentially looking for an optimization on a landscape and looking for something that solves the lowest loss for a specific network. And it's usually like you're going down a hill, as I guess is the metaphor. But of course, in life, we try to go up the hill. And so that was the idea, is to invert that thinking and to ascend little by little towards some optimal endpoint, which we hope is higher than the rest of the endpoints that could have been. So that was the idea. Although I've never articulated it until now, but that was the idea.
I was deeply curious on it because I was like, there is something there when I came across your blog. And just for our audience, just to timestamp this, roughly what year was this where you were writing the blog?
I think I started writing it in 2017 or 2018 is when I started writing. I was writing before, but that particular blog, we started around that period of time.
What were you writing before?
I guess I had a couple startups. So I was always sort of writing on the blogs of those startups. But yeah, this is the first blog I had where I was writing sort of on behalf of my own thinking.
I see. We might cover some of those startup journeys later in this conversation, but I don't want to promise too much because I would love to focus most of this conversation on how you think about things at Level. But before we dive into Level, I promise we'll get there. If I did my homework right, speaking of engineering and all that, I believe you started coding since you were 12 years old. But since I'll be honest, as much as I was looking into this, I couldn't find out how it all came together. So for our listeners and myself, what does one need to understand about your childhood and early upbringing to appreciate the engineer and finance person you are today?
Yeah, it was sort of an organic path, but yeah, I guess since I can remember, I've been interested in technology And even in high school, I was in charge of like the computer lab and setting things up and writing. I guess I wrote my first piece of code that was actually used somewhere was writing an automation script to update like all the computers in the computer lab in high school. Which at the time, like they weren't thinking like that. And so that was like my first foray into computers. I used to build computers when I was young, and I think like I had an aha moment when I had I guess I had two Apple computers and Macintosh or whatnot, and it was the first time, I think it was Apple Talk at that point in time, but it was the first time I ever networked two computers together and they spoke to each other, and I was like, wow, that's amazing. When I went to school, I actually started coding a lot more, and I took some engineering. It was more of a business entrepreneurship school, but I started coding a lot more. And it was back then. It was Java, and I took a class by one of the creators of the credit card strip, which was amazing. Like it was and so I was really inspired by like a practical application of coding. And then I ended up getting my first job in Wall Street, which is where, and I had never done like sort of coding sort of full time as part of a team, part of a large infrastructure, and those were the 2.5 years where I really just spent learning everything I could about systems engineering, coding, and then a little bit more quantitative kind of engineering. So that was my journey there.
How did you find your way to the computer lab? I mean, like it's one thing to be coding when you were 12 and like as a hobby, but how did you find your way to like, I've got to be in the computer lab and eventually like effectively take it over?
Yeah, no, it was just more natural. We used to we were into games back then. I had a lot of my friends we weren't nerds actually. We're not. We were pretty cool, but like video games was a big thing, and on the computer, and we used to like sort of optimize the computers that we built for gaming. And
what does that mean?
We used to like rebuild, like basically we customized the the motherboard, the configuration, the RAM, the visualizations, everything, sort of the displays. Back then, the architecture really. And then I think I don't know if it was an internship or I volunteered, but I ended up just volunteering to work there, and that's how it started.
Very interesting. And one of the things that we brought up before we clicked the record button is we talked about networks beforehand, and you mentioned that your interest in how networks overlap started back in your Wall Street days. What does that mean for someone who's trying to wrap their heads around like what was the inception story?
When I was I used to work at Lehman Brothers. This was before, way before the crisis. But and I was part of a team, if I recall, that we were doing enterprise engineering, large scale. We were focused mostly on like sort of analytical and reporting systems initially.
Yeah.
All the reporting for like private client services and other things was like through our team. It wasn't a large team, but anyway, so in that team, I was focused on just basically I was a contributor and coding, basically coding Java and deploying Java, and as part of like a whole framework of coding there. It was Java Enterprise. And then I guess at one point I met one of the money managers there, and we became friendly. And she was she had sort of a large pool of capital. And she was interested in essentially developing a model that would capture her thinking, in her trading thinking, so that she would have like a signaling engine for trades, and then I could use that as a way to monitor the market, have some screens, and then actually deploy some capital. And so she said, why don't you guys build it, your team? And I said, okay, I'll build it. And so I had to sort of negotiate internally because there's a lot of politics and bureaucracy there, to actually get elected to be the person that can work with her on this. And so that was the first time I actually thought about essentially trading and thinking about the various systems that go into time series and market data and some of the other ideas that she had, and integrating all those, synergizing all that data into something that can be a trading system, or it's not a real time trading system, but like a signaling system. And so that was like my first foray into what I consider to be like time series analysis and sort of data, some form of data science. And that was like an aha moment for me, because I realized that this is what I want to be doing. And so that was like sort of how I got into data analysis and sort of trading and thinking about finance. But it wasn't until I had my first company. So I ended up, I wanted to build companies always. That was always what I wanted to do. And so I ended up, teaming up with an old colleague of mine who also graduated from Babson. We were good friends. And he wanted, and I was a good engineer, somewhat good engineer, and he full stack, and he was a very good creative person. And so he said, why don't we just start like an interactive kind of digital agency? And, we'll just essentially start doing websites and other things. And so we ended up starting that. The firm grew, but we ended up starting that. I believe that was in like 2004 or something, 2005, a long time ago. But anyways,
not too long ago. It's still post 2K.
Exactly. But then, if you recall, there was at one point there was the emergence of these of like Napster, and then after that there was this sort of wave of peer-to-peer systems, like BitTorrent and those kinds of applications where you essentially network computers together. There's not really a centralized sort of node that controls the connectivity, and the network sort of discovers on its own its resources, and then you sort of you push resources on the network, and they find the end user depending on sort of the hops and all that. It was just very, very fascinating stuff. And of course, like that's served in like file transfers and all the stuff that came out of that. But I was just completely fascinated by that. And so that's where I started really thinking more deeply about networks. And from that, I ended up reading a lot of books about network theory, social network analysis, and things like that.
What were some of the books that you came across and read?
I'll send you a couple of the books that I remember. But there was a lot of books around just like social network analysis and networks generally, and then graph theory, but graph theory is more of like a mathematical field, and there's a lot of writers in there. And then like different aspects of linear algebra. And then I read one book that I remember now about Google's search engine methodology. It was a very it's a very mathematical dense book about like their search engine. And I still have it actually, but it's sort of, from that point on, I realized that you can think of networks like a search problem. And there's a lot of parallels as to how networks emerge, and then sort of how social networks operate. And then generally, when you talk about networks, also the economy, of course, is a network. And so that's a lot of my thinking came from there. And then, in fact, just to kind of like to progress, like in terms of we were thinking about these problems, I ended up. So I had this ad agency. We built it over 4 years in New York, 3-4 years, and we ended up getting a lot of large clients. At that point in time, advertisers were thinking about how do you like bridge the digital and the physical world, and we were doing a lot of like interactive digital things.
Okay.
And we also ended up building. We also had 2 print magazines, which is interesting.
To backpedal a little bit, but like, why did you always want to start a company?
I guess my legacy is entrepreneurship. My father, my father's father, my father's father's father, and probably, and I don't know, I don't go much farther back than that, but they've all have been entrepreneurs, business builders, either by necessity or just by that's kind of like like in their blood. And actually, I have most of my family is entrepreneurial. I have cousins that have founded big companies, and it's just sort of like the family's entrepreneurship. Mm-hmm. And then also, I went to I went to Babson, which is very entrepreneurial, and in my mind was always like startup was always in my mind. And I never really, it was always something I wanted to do.
Were there kinds of conversations you would have around the dinner table, let's say at home with your father or your grandfather, that continued to ignite the entrepreneurial flame in you?
For my first cousins, there was a lot of interaction around business creation. Like we actually started a company in college. It was called Target College. And by the way, this was like before Facebook, but it was very simple. We would like, if you would go out somewhere or there was like a party or something, we would just take photos and post them online and then share them with the people that actually went to the party. And it was just like wildfire. It was a very simple thing. And obviously we saw what came out of that, but yeah, and that was called Target College. And we had built, that was like my first foray into entrepreneurship. We had kind of fizzled out because we all kind of went our separate ways. It was like we were still in college, but So it was always these kinds of conversations and building things. And then one of my cousins actually started. He's one of the founders of Zumba, the large fitness company. And him and I would be, he was also into Babson, and him and I were always talking about business creation. It was just like it kind of was in the blood.
Gotcha. Okay. There's a lot of what is the saying that goes again? Like you're the average of the 5 people you hang out with most. And in your early life, it just seems like there was a concentration of entrepreneurial talent consistently around you.
For sure. And in Babson, of course, everybody's thinking about creating a business.
Yeah.
And so you just had a lot of exposure to conversations with friends and colleagues. I even have a colleague that I work with now, who's a partner now in our business that I met at Babson. So it's just, it was just like everything you spoke about was business creation, value creation, and entrepreneurship. And so when you're kind of like in that flow of information, it's all you think about. And of course, there's nothing like creating a business.
Yeah.
It's extremely hard, very painful. And a lot of ups and downs typically, but especially when you're young, I've made a lot, you make a lot of mistakes,
as young people do,
especially when you're doing your first startup. And I think I did my first startup like 23 or 22 or something. So you just make a lot of mistakes.
Okay. So going back to the original track of what we were talking about earlier, because I put a pin in that, you mentioned recommendation engines.
Yeah.
And I imagine a lot of it informs the beliefs you have. And this is how it will ease into the world of Level Ventures. But how do you think about recommendation engines today in the process of investment opportunities?
So the recommendation engine, which I guess really started with Netflix and some of the work that they were doing, and some others before. But back then, one of the methodologies was focused around something they call collaborative filtering.
Okay. What does that mean?
Basically, so you can look at recommendation as, here's an individual, here's some history on that individual, and let me see if I can use that history to forecast what they might like, for example, either content or movie or whatever it is. And you look at it like in a singular view. But of course, that has a bunch of different problems to it. One is you don't always have a history on a particular user, right? And it's a lot of new users all the time, so that's difficult. It's called the co-star problem. And secondarily is taste might evolve and change, and you can always the history doesn't define obviously the future, and of course, like the history might be very sparse relative to the future. So one of the innovations that was developed, and this was a while ago, was this collaborative filtering. And basically, the high level premise is that you can use like the wisdom of the crowds, let's say, to compare users to each other, see if they're similar at large scale, and then use one users as a proxy for another. And if you can sort of fill in the recommendations they might like based on others in the system. And you do this typically using large scale like matrix factorization, which basically means like you look at a grid of users and you try to figure out what the factors that are similar between them, and then you sort of generalize one user from a set of others. And so if you think about it, that methodology is essentially using the sort of like what is apparently like the random behavior of many individuals, and the individuals form patterns of behaviors that are similar to each other. And so some set of users, while they think they're unique and different, actually fit into a set of users that are similar in their patterns of behavior. And the reason is because networks tend to form around what they call homophily, which is like similarity of interests and tastes and things like that. In the case of
what was that word again? Homophily.
Homophily, yeah.
How do you spell that?
It's like similar. It means like sameness.
Okay.
HOMOPHILY. I guess it's a Greek term.
Okay, I clearly didn't do my Greek and Latin roots well enough.
Yeah, it's a weird word. So it's not a word that's used. It's not often used, but yeah. So I guess the taste building process of an individual is not something that happens it's very dependent, right? It's not an independent process, and so it's not surprising that tastes develop, in ways that are shared across a set of users that have some set of shared behavior. So anyway, so that's what's used, right? It's like that's the core premise of it. It's like using that as a way to learn, to essentially predict what a user might like, right? But what's interesting about that, of course, is like what you're saying in the bottom line is that networks themselves have some structure, And so they don't evolve randomly. They evolve over time through behavior. They evolve structure. And that structure then affects the behavior. So like you have behavior co-evolving with structure. Mm-hmm. And that is an amazing concept because it means that networks have a life of their own. And once you know that, you can detect patterns from the network, which then you can use to make decisions about individual entities. And I think that's what's interesting about networks. One of the things that are interesting about networks. So that's what collaborative filtering really is. And so that's the stuff we were doing at my second company called Stylecaster. It was an ad tech network focused on beauty, lifestyle, media. But anyways, that's what we were doing.
How much of that, the genetics of recommendation engines and all that, inform the way you think about investing today at Level? And maybe just as a high level, right, of where Level is at right now. Level, you're a fund of funds, but you invest in both emerging managers as well as you invest directly in the companies. And so how do you weave that? And is there a through line between recommendation engines and the things you did at Stylecaster into the world of Level Ventures today?
Right. I think in life there's always a through line. So just to kind of step back a little bit. So so recommendation is sort of one area in which networks are used. They're sort of used in a way that's not directly, right? Because you're sort of looking at behaviors, and then you have sort of a latent understanding there's a network there, but it's not like you're actually reconstructing a network per se, right? But nonetheless, there's a network, right? It could be a network of similarity, but it's nonetheless a network. So, but however, if you if you think about networks more generally, right? One of the largest networks, of course, is like the economy itself, right? Which is the interrelationships between people and entities that are transacting, which is like the network. There's an area of research that I've been looking at for a very long time, and which I think formed the basis of what Level does in some ways, which is called complexity economics.
Okay. Do elaborate?
Yeah, I will elaborate. So networks are complex, right? Because they're dynamic, they evolve, they change, and they have certain properties that are unstable. So for example, if you look at there's always like this example, like if you look at the most popular artists on Spotify, for example, or the most popular songs, and you were to plot them on a distribution, you would find out that they were power law distributed. Mm-hmm. Right, where a lot of the attention or a huge amount of attention goes to very few tracks, and the rest is sort of long tail. And the reason for that is because of the nature of networks. They're very dynamic, and you have these sort of feedback loops that generate these sorts of behaviors. And it's also networks that generate sort of boom and bust cycles, right? That there's there's this notion of feedback loops, fear of missing out, fear of greed. All these different things are properties of networks, right? That exhibit properties which are dynamic and sort of complex. So the economy is no different, as we know. And traditionally, the economy has been thought of as being like an efficient market, right? Where all of the information about a price has already been reflected in the price. And so, basically you have supply and demand, and the market reaches equilibrium based on those two forces. But that's not what happens in reality. In reality, the markets are very inefficient, and there's supply demand imbalances that happen all the time, and there's boom and bust cycles and all these kinds of things. And the area of theory around that is called complexity economics, and it really tries to understand how why are markets sort of non-equilibrium, and why are things inefficient at times, and how is that driven by sort of network activity, network behavior. And so that's a very interesting area that we've looked at for a very long period of time. And I'll tell you more about how that sort of parlays into Level, but I'll pause there if you have any questions on that.
So first of all, this podcast is my version of a flak jacket to ask dumb questions to smart people like yourself. But there was something you mentioned earlier when you were talking about fear of missing out and all that I don't think I've heard before, which is let me know if I heard this wrong. The fear of greed. And you mentioned like networks are affected by the fear of greed as well. What is the fear of greed?
No, I say it's fear or greed, sort of fear or greed. So like,
fear or greed.
yeah,
Okay,
exactly.
I've
Yeah,
completely misunderstood it. Okay.
Yeah, basically, there's emotional states. So just like a person has emotional states,
Yeah.
right? The behaviors of a network of people also exhibits emotional states, as if like there's an emergent property of a network that also is very similar to the emergent properties of an individual.
Yeah.
And so that's what makes the market so volatile and so hard to predict, is this dynamic nature of behavior and how it affects itself on a network. So anyways, that's what I meant by that.
Is there a way to track or to predict fear and greed?
So dynamical systems by nature are very difficult to predict. All you can predict is that they'll have those cycles, right?
Yeah.
And that, I think as an investor, you have to know what cycle you're in, right?
Okay.
And once you know what cycle you're in, you know sort of how to operate, right? When there's a high risk tolerance, you want to be careful. And when there's a high risk aversion, you want to be, more opportunistic. And you need a way to measure those two things. It's usually very obvious where the market is, and there's very few metrics that you can look at that will tell you like the market is sort of overbought or oversold, generally speaking. And it's and of course, like in venture, you have multiple kinds of waves. Like of course, there's a huge AI wave today, and you can argue one way or the other that it's a bubble or it's not a bubble, or it's a platform shift, or there's a lot of experiments that will go wrong. But you have to have an understanding of the regime that you're in for you to actually make good decisions as an investor. And I think that's sort of important because I think typically what ends up happening is that investors don't necessarily think about the various participants and the market that they're in when they're thinking about specific investments. Not always, of course, a lot of them do, but anyway, so that's how I think you use sort of fear and greed. It's more of sort of understanding the regime you're in.
I imagine for a lot of our listeners, I feel like most of them would know which regime they're in, fear or greed. I guess the larger question here is, are there telltale signs to know at what part of the curve of fear and greed of that regime you're in?
Yeah, I was gonna say, like, you never know when the end of a cycle is, right?
Yeah.
But knowing where you are in a cycle it gives you a sense for how you should play it, right? Yeah. And there is the notion. I mean, venture's a little bit more. There's a lot of inefficiencies, and I'm not sure how important price. We can talk about price generally speaking as a signal, and sort of intrinsic value. There's a lot I think we could talk about there, but generally speaking, prices sometimes reflect the inefficiency of the market, and you can always get a sense whether what you're paying for something, what the implications are of the prospective returns that you think you'll get, right, into the future, right? So you always have a sense for that, because it's not about what you buy; it's about what you pay in many cases, and so the regime will tell you that, right? And how irrational others are and their beliefs about future cash flows, right? We saw that in the ZIR period. Even though you could just succumb to it, right? Obviously, investors are very emotional, and they just you just succumb to the fact that I don't want to miss out on this ride. But of course, that separates really good investors from really bad ones, I think.
Is it too simplistic to say that revenue multiples and valuation multiples are where price acts as a signal for where the market's at? Or are there other factors that you think heavily lend itself to understanding where we are in a specific regime?
I believe that the nature of, so I think what really matters is the nature of what you're hearing around you, right? I think that's a lot of it, to be honest, is when you hear very overly coherent narratives. I think that's a big thing for me. And it happens in sub-cycles as well. So you hear things, I mean, a good example is like AI is taking over jobs, right? Okay. So again, there's some truth there, right? But when you actually unpack it, it's a very nuanced thing to think about. There's some areas that will be impacted more, some less. There's the reskilling. There's like, it depends on what kind of AI you're talking about. So when you actually take a narrative and you break it down into its constituent parts, and you take it from something that's like overly coherent to actually something that reflects the world, then a lot of things start to break down. But when people are behaving and making decisions based on narratives that are overly coherent, I think that's a big sign for me. At least for me, that's something's off, and that's a very social problem, right?
Right.
Right, because it's in venture there's a lot of syndication. People tend to invest with each other. They reinforce each other, and so you can have networks that go off into directions which are very inefficient.
I mean, obviously AI is a general trend line these days, and agentic AIs and as well. Are there other, let's say, to use your vocabulary, overly coherent narratives you're hearing in the venture world right now, either from the LP side, GP side, or
all the time? I for example, I think defense is another one. Recently, I have a lot of.
That is a popular thing these days. It's the flavor of the month.
A lot of examples of this, but let's say defense.
Yeah.
We have for the first time startups building missiles, right? In some cases, I've seen startups that are building, propulsion engines and missiles, and I think that's all great. These are typically not venture backable businesses, or not businesses that have venture scale returns. Because what you want to see in a venture company, right, which is you're looking for huge outliers, is you want to see increasing returns to scale, and you want to see demand side feedback loops, right? Where you just have a very low marginal cost of distribution, and that requires mostly winner take all or winner take most kinds of markets. And I don't think like jet propulsion is that, right? You can have a supply, you can have some interesting approaches, but but again, like very few companies will actually get to scale. SpaceX obviously got to scale because it's a vertically integrated, rocket company. But my point is that defense as now a narrative is, we're expecting, of course, that there's going to be a recreation of the industrial base, the military industrial base and all that. But a lot of these businesses are not going to succeed because it's very difficult to contract with the government. It takes a long time, and it's a narrative that you have a lot of investors chasing defense companies, which I think a lot of them will die.
I was always curious, like where the defense narrative started, and did it start because of the current political climate, or are there other things that led to the rise of the defense narrative?
Yeah, I mean, I think because we were investing, we do believe that I guess timing is really what matters, right? It's like you want to be pre-narrative, right? You want to position your capital in an area where the supply of capital will increase over time, and where those assets will sort of trade at a premium. And so we started doing defense really early, I would say, like in 2021, which is right before it started to become a trend. I think it sort of happened around some of the geopolitical stuff, but not exactly. I think like maybe with Anduril as an example, they were seeing certain inefficiencies in sort of like prime contractors, and maybe they felt like that we were at a period of time where we need to sort of radically change the way that we did defense. And it was a radical thinker in building a business in a world that didn't know it needed it yet, right? That's what entrepreneurship is, right? But then then with that, and then like maybe with Andreessen's American Dynamism, narrative, which is a good narrative. They're really good at creating narratives. So
they're
I think
some of the best marketers out there.
Yeah, they're the best at it. So with that together, then I think this whole kind of area emerged. And now there's a couple companies at scale. There we have one, which is Shield. We're part of Shield AI. And there'll be others, but I think they'll be very, I don't think there's going to be maybe a handful of really at-scale companies. They're really large at-scale companies. And then a lot of the experiments, I think, it's almost like it's maybe too late in some cases. So I think timing really matters in venture. It really, really matters.
To switch gears a little bit, I've been holding this at bay for long enough. And we talked about this right before we clicked record as well, which is the first time we had chatted, you kind of like laid the ground to here's what we're looking at in terms of data at Level. And I found it fascinating because you were looking at things that most people wouldn't think about. So before we get into the thick of things, are there elements of networks data that you are measuring that you think most other LPs are not even looking at?
I think so. And I don't think I actually don't think a lot of people think about things in networks. Networks is almost like a paradigm of thought. It's not just there's a network. It's actually there's a paradigm of thinking. And so I don't think a lot of people look at it this way. And what we really try to do is we try to reconstruct networks, right? And it's the relationship between different entities. And in capital markets, because of the nature of venture, for example, investors tend to cluster and they tend to form behavioral patterns in their investment activity, which we believe affects future behavior. And there's like this cyclicality between what you do, the network that gets constructed, and then what you do next. It's like, I think it's basically called path dependence. And so what we're trying to really measure is for a given investor, let's say, because we do a lot of investing in early stage funds where there's actually not a lot of track record data. It's really more about, can we learn something from the network we believe they have based on all the data that we're collecting that would allow us to make a prediction on, given their position in the network, how they'll perform. And it's surprising that these features actually work really well, because networks are almost more persistent than performance. Because performance itself, first of all, there's a lack of serial correlation in venture if you look at like venture funds over time, but also there's a lot of false positives, right? There's a lot of I just got lucky, right? Or I was part of a syndicate that got lucky, versus someone that's persistently able to access high quality deal flow over a long period of time, which networks tells you more than just looking at track record. So we actually look at the whole problem very differently, I think, than you would if you were just underwriting if you were just an LP underwriting, a fund for the first time.
And so obviously this is a huge oversimplification, but I think most LPs, what they do is they will, they look up Albert and then they look at LinkedIn and they go like, who's connected to Albert that I'm also connected to? They'll look at mutual friends, they'll scroll through that list, see who they're really well connected with in terms of mutuals, and they'll see what impressive folks that you also know. And that's how, obviously I'm oversimplifying a lot of what LPs do, but that is what a lot of capital allocators do when they're underwriting a fund, right? How are you looking at network differently? Because you've built this proprietary database of things. When you say you underwrite kind of like what a GP, what their position is in the network, what does that tactically mean?
Yeah, so maybe I'll give you I'll show it to you an example, but of course in venture, one of the key networks is the co-investor graph, right? Which you can learn, you can learn that from investing behavior, of course. And so, if you look at over many years, but if you look at all of the investing behavior across all investors over a period of time, you can essentially, this is a simplistic version of it, it's more complex than that, but you can reconstruct a graph of essentially relationships between investors. Now that graph, with this network graph, essentially the way you can think about it is that there's a flow of information between investors. So there's like an arrow, right? When you have two investors connected to each other, it's not that it's unidirectional, it's bidirectional, meaning that, if I'm an early investor, I create signal because ventures obviously, there's stages, I can create a signal for a downstream investor. And so over time, if you repeat that process over and over again, you come up with this very complex network that has flows of information between people in the form of signal, right? So taking that, right, which that's the oversimplification of what we do, but like taking that, you can develop sets of algorithms, right? In our case, we use very sort of highly customized graph neural networks, which are essentially like neural networks applied on graphs, to make predictions on managers. And what we really care about is whether a manager will be a top decile performer, right? And in venture, that really, really, really matters because it's a very asymmetrically skewed, highly dispersed asset class. And so you have, you really got to select well, otherwise you'll underperform in a big way. And so what we try to really do is have algorithms which give us a sense for whether, with some confidence, we believe someone will be in a top decile of performance. And that's sort of kind of what we do, layering in multiple kinds of networks, not just co-investor graphs.
So speaking of networks, right? I imagine like everyone else is looking at co-investor graphs. They're looking at LinkedIn networks. They're looking at like Twitter networks and all that. Those are the simplest, lowest hanging fruits of networks. Are there other kinds of networks or how you parse the data that other people aren't looking at from like a tactical standpoint?
Yeah, so we have a lot of kinds of networks. So just to give an example,
Yeah.
Talent is another big network, right? We look at the flow of talent, right? Which we have a couple 100 million people profiles that we track on a regular basis, and we look at their overlap between company formation and talent flowing into it, right? Which is which gives you a sense for for a particular GP, what they have access to from a talent perspective, and if there's like recurring themes there. So that's sort of one big network, and then there's a bunch of other things. Like for example, we look at scientific journals and looking at academic networks. We look at sort of open source code networks like GitHub and things like that. Those are also networks. So everything's a network, right? It's just a relationship between different entities. But really in venture, what matters is, of course, like the investors, the capital, and then the actual talent. And so what we try to understand is the relationship between those two and how those two things are evolving over time. We believe it's very true that the position of a particular investor at a particular point in time relative to sort of being close to the core is very important in terms of accessing the best opportunities. Because in venture, as you know, it's sourcing is everything, right?
Yeah.
And the position of the network really allows you to source better. So, anyways, that's kind of how we think about it. Picking is not as important as sourcing. Like you can actually, right? It's like in some ways that when you're talking about, I'm talking about early investing, not late stage investing. Like early, like it's just having better network qualities.
I actually heard a friend who's been a capital allocator for the past like 15, 20 years say that, and a lot of this may change because venture is always evolving, as you and I both know. But he says like it's much better to have a really great network and an average picking ability than to have a great picking ability, but a really not so great network. And
then of course, like in venture, it's asymmetric, right? So it's not everybody does not have access to the same networks. And by definition, networks, they're clustered. That's my point about structure, right? They're structured in particular ways, and those particular ways then affect the behavior of individuals, right? And so, like you basically, the network of those around you actually affect the information that you actually aggregate, right? Generally in life, but also in venture, what you're gonna have access to is really impacted by the nature of your patterns of your behaviors.
Yeah.
So we try to understand that really, as soon as possible, right? And try to get some early signal with GPs and maybe see things that others don't see and see things before others do. And that's kind of like our approach. And if we do that well, then we should have hopefully, a portfolio of outlier funds.
When you're looking at networks, are you proactively you have like hundreds of thousands, millions, I don't know, folks on the network, or you're just actively looking at it and you're like, hey, actually, there's this one node that really stands out there. I don't know if they're raising a fund or not. Do you proactively reach out to said individual, or do you start assessing their networks after they come through the inbox, they pitch to you, they send you their pitch deck? Like, what part of the process does this network analysis happen?
Well, I guess it's both ways. So we have like an outbound approach, which encompasses everything from looking at SEC filings to looking at our leaderboards of who's like scored really well, or looking at GPs. Like we look at partners at other firms or senior people at other firms and just tracking to see if there's movements and things like that. So that's kind of like an outbound approach. But over time, I think we've developed a brand, and a lot of it is referral. So we get a lot of inbound. And so the problem becomes more of like, how do you do a first pass filter so that you focus yourselves on the right, sort of on the right things and the right opportunities. And so we have a methodology for doing that, which involves a lot of data science, but also other things. And so that's kind of like once we feel like there's a threshold, then we can actually start doing the work on the fund. And of course we will miss things. It's not like, there's only a level of certainty that we can have on our models, but we'll miss things. But what we care about is just sampling from funds that we think will be top decile. And so that's really what we care about. And then helping those funds succeed. And so that's sort of like how we think about the problem.
As the data suggests, or your algorithm suggests, are there archetypes of emerging GPs that fascinate you the most that are outside of the normal, let's say, spin outs out of top tier funds or like unicorn founders starting their own fund?
Yeah, there for sure. For sure. I mean, I think there's personas that we really like resonate with us. Like operators turned investors. Certain kinds of operators turned investors we like. We think it's a really good persona because founders love founders, right?
Yeah.
So that just works. So we have like we're an investor in Workshop, which we love, is Max Mullen from Instacart. So it's an example of like that kind of persona, which I think it just resonates amazingly well with founders, and we don't question his network, right? Even though we see it, we don't question it. Highly scored in our systems, et cetera. So that persona we really like. I think there's also the notion of an angel operator, sometimes angel then turned investor, which is great because angels need to really hustle, and we like that. We also like more junior partners sometimes, or junior folks at these organizations, starting firms. They're very, very hungry. And usually like this, the associate level or like even principal level, they're really in the flow of networks, right? Where sometimes the higher folks, they're not really on the ground as much. Not always the case, but we've seen that. And of course, like venture's generational, right? And so the young, it's always like this recycling of age in a way. You want to have some sort of match with the entrepreneurs themselves. So I think there's a benefit to that.
Anecdotally speaking, to be going on the point of principals and associates and all that, they're often the folks who are at events. They're hosting their own events. They're writing content. They're producing all these things. And there's an element of hustle where when a certain firm is being represented at an event, it's more often than not, especially the folks on the floor, from a junior person than from a senior person. So they're talking to folks all the time. So anecdotally, that seems to check out.
Yeah, it checks out. And I think sometimes when the GPs are like very large and they start new firms, they're usually very big. So, we basically look for three things. We've kind of like boiled it down to three things. It's hard to actually do this, but there's three things. Venture is someone once told me, venture is simple but hard, right? Which means like anybody can do it, but to do it well is very difficult. But anyways, there's three things we look for. One is what we call network advantage, which is somewhat obvious, but I think if you unpack that, there's two things. One is there has to be a network that is non-redundant, right? Because in venture, you find that everybody has kind of like similar networks, and there's a lot of redundancy. So I can have like a network, but that like 20 other people have the same network. So we don't want that. You want to have a network that's like really non-redundant. And so that's one thing that we look for in our data. And the other thing we want a network that's economically important, right? Which I think is obvious too, but you want to be access to a set of things that will be very impactful in the future, which of course takes some work to be thinking about, et cetera. But that's important to us because you can be part of networks that it may no longer be relevant, right? Because the world has changed.
What is an example of economically important? In my mind, I'm thinking it's a difference between, I'm making this up, Palantir versus Xerox.
Yeah, it could be like coming out of big companies for sure. And Palantir is obviously much more. Xerox doesn't exist, but what, I guess it could be that. But for example, sort of go back a few years, like the emergence of like transformers and attention networks and what became LLMs, large scale. That is a very important network that wasn't important if you kind of like look back 3 years before, right? Mm-hmm. So that's like an example of something that changed. There was a huge platform shift, a big sort of inflection in innovation, like a quantum leap in innovation. Now these networks really, really matter, right? And then maybe traditional networks like that were more focused on like vertical SaaS. Traditional vertical SaaS is maybe not as important. Not that it's not important, just that maybe it's not as in focus, et cetera. So that could be it. Palantir could be another example of like a big tech where the people are spinning out of, and it's highly relevant because of the nature of the business that they have and where the world is going. So that's another example. Whereas maybe people spinning out of more of a like Salesforce or something maybe is not as important depending on what they're doing. Again, these are all kind of like these are have to be qualified statements, but. Yeah. But anyways, that's what I mean by economically important. You have to have an estimation of what we think will be economically important in order to make that statement, of course.
Right. So you have to have a view on the world, and that's probably a little bit more opinion-based than historical data-based.
Yeah, I mean, these days we're actually doing a lot in data. We also ingest like huge amounts of unstructured data from everything, everything from podcasts and blogs to all the data that we get from managers and other things, emails, exchanges, etc. So we extract certain weak signals to see what things might be becoming important, and we can use that as a guide as well. But we can talk about that's kind of like a whole longer conversation, but yeah. So
this needs to be a Lex Friedman 5-hour podcast at this point.
Yes, I'm happy to do it.
So I rudely interrupted. So you said 3 things. There's the network advantage. There's the economically important networks.
Yeah,
I think I might have missed.
So network advantage is the first thing.
Okay.
But to qualify that network advantage, it has to be we believe to be economically important. Gotcha. And also that there's non-redundancy, right? Because you want to be the one of the only access into that particular network, or have a very unique access to that particular network, which I think is important in networks generally. Otherwise, you really can't be a broker at all of information. I mean, and then not surprising, the other thing is knowledge advantage. And there again, it's the same thing, right? It has to be economically important, right? And it also has to have non-redundancy. Like you have to be one of the very few that hopefully has that information or has that knowledge. And that makes
non-consensus that most people talk about.
Yeah, non-consensus. Or for example, you could just be a highly specialist. You've built, for example, a company in the aerospace. You've scaled a company in aerospace. You have all the networks. You have all the knowledge on how to build an aerospace company, all the complexities around supply chain, the complexities around hardware engineering and hiring and sales. And so that is just very unique information that a lot of people do not have. And so anyways, that's an example of that. And the world's getting more complex, I think generally speaking. And, also technology is becoming more like there's a lot of complexity in technology. The kinds of businesses that people are building today are touching the physical world. And because of that, you're dealing with, atoms as well in many cases, whether it's in life sciences or whether it's in sort of the physical world, et cetera. So anyways, my point is that knowledge, that specialization becomes more and more important, especially in areas that have not yet, you've scaled in areas that others haven't. So that's the other thing. And then the third thing is, I know we're going over, but the third thing is the fund strategy itself. And there's a lot of nuances to this, but there's 2 things that are important, I think, in my opinion. One is that it could be an outlier. So we know that like as venture scales, typically speaking, it diminishes returns, right? So if you look at the upper end of small funds versus large funds, and you look at the 90th percentile, you'll see that small funds always outperform as a basket, the larger funds, and it's really because it's just statistics and ownership relative to fund size and all that sort of stuff. So it has to have like the right construction for us, which is for us means small. And then the second thing is
what does small mean? Does that mean like sub 50, sub 100?
I think the threshold's hard, but we say sub 100 because it's like a nice round number. But my second point is actually more critical, which is the game theory, right? Which is like the competitive dynamics in the market. Which that actually sets the threshold at which you can make funds work, right? Because it's much easier, as you know, to get if it's a positive sum game where you're really just trying to get 250K or 500K checks into companies it's not that it's easy, but it's you're not pushed out as much, let's say, than if you're trying to get lead a round, a $3 million round. So you have to be really, really good to scale up, let's say, to $60, $75 million, even though it seems like it's not a big jump. But it is a big jump.
You are actively fighting for someone else's equity on the cap table. And the founder has to choose, should they take you or someone else, versus the 250 and under check is just like everyone's friends. Everyone can take everyone's money kind of thing.
So, and there's not a lot of, especially when there's a high signal founder, there's like no, there's alpha's gone, right? It's just because all the big firms will just pounce on it. Anything that has signal is going to be an auction around it. Whereas like what you need to do as an investor is, I think to get true alpha is really get to things really early or when they're illegible, before there's a signal on them. And that just means that funds have to go earlier and earlier, really, to be honest.
I mean, back to the knowledge advantage point, the non-consensus kind of non-redundant kind of knowledge
Exactly.
advantage that one would have.
Yeah.
Out of curiosity for you, and this is my like, let's say, last hard-hitting question, so to speak. But there's I'm forgetting the attribution. I believe it's Ronald Case. But he once said, if you torture the data long enough, it'll eventually confess anything to you. And I'm curious for you, because you focus so much on data and networks, and you have all these algorithms and the ways to think about things. How do you walk the tightrope between over-diligencing versus under-diligencing a deal?
It's a great question. And I think you don't want to over-intellectualize a deal, generally speaking. I think it's bad. Because you're never going to get, there's just fundamental uncertainty, right? You're never going to get to the point at which you have full certainty. So there's a point at which if it checks a certain set of boxes, then you're building a portfolio of bets. And so you have to kind of, you hope you have a high volatility bet, and you're constructing a portfolio of high volatility bets. So once it checks the box, I think you got to make a decision. We have we try to like balance the human in the loop kind of process. And we think about it more as like stages of using data. At the highest end is like there's a prediction, and it's a black box, and you believe it or you don't. But we don't think that way. It's like there's a prediction and there's confidence bounds. Then if you kind of go a step down, it's really like decision support, right? Where you're saying, give me some explainability or give me some modules that give me an insight into a particular area that I want to sort of de-risk. And then there's just literally analytics, which is just kind of like data, right? Without sort of necessarily any intent. So anyway, so that's how we think about it. Is this we're trying to build a system that has a human in the loop, and that we can inform the human, in this case us, on what to look for and what to de-risk actually in the market. Because we do a lot of work in market. We do a lot of back channeling that's informed by data. We try to figure out what we think the gaps are and sort of get those solved really quickly. But at some point, you need to make a decision.
So we're in the back half here. And as we're getting ready for the curtain call, I'd love to ask you two more questions. So I'm really, really curious, and this is designed to be quick fire-esque questions, but you can take as long as you need to answer the question. So out of curiosity, from getting hired, and one thing I noticed in my research, but like you, from getting hired straight out of school to work at Lehman Brothers, as you mentioned earlier in this conversation, where your start date was, correct me if I'm wrong here, September 11th, 2001 on the 40th floor of the World Trade Center. How do you think about the role of serendipity in your life today? Yeah,
so I believe that everything is divinely ordained. And it's more like you're guided to things. So from my perspective, it's not serendipity. It's just like the universe willing it.
Okay. I love it. Okay. Last question for you. I taught the person who introduced us was your teammate, Jake. And he once told me that you're a huge consciousness expert.
Know that.
Could you unravel the magic of what it means to be a student of consciousness?
So I wouldn't call myself a consciousness expert. We've read a lot of books. I guess I've also on the team. We talk a lot about it, but I've read a lot of books on just understanding the nature of consciousness and reality, and the interface between consciousness and the world, which is very fuzzy. And so, we've thought a lot about that particular. I've thought a lot about that particular area, and so I think that's what he meant. We've spoken about it at length.
Is there one thing that you think most people, let's say, fail to appreciate when it comes to consciousness?
I think that yes, and there's no way to prove this, of course, but I actually do believe consciousness is generative. That you actually you create the world around you. And it's not that you are a passive, consumer of reality, which I think is like the way people traditionally think. Is actually you are the creator of your reality by your thoughts. Where a person's thoughts are where they are, in fact, physically speaking. And so I think that's that goes into the realm of psychology versus reality, but I actually think that physically speaking as well, which is what you see a lot in sort of in quantum mechanics and sort of the kinds of things that happen in the quantum realm that you don't see in the classical realm, which is like this fuzziness between the observer and the observed.
A podcast for another day. Albert, thank you so much. This has been incredible. I don't know if you could tell, and I was just like scribbling notes on my notebook over here, and I'm just like, oh my god, like every time you say something, I have more questions to ask, and then we run out of time before we run out of topics to talk about. So thank you so much.
It's a pleasure.
Where's the best place for people to find you if they are curious about how you think about things? You post a lot of white papers as well. Where do people find you?
Yeah, so LinkedIn. I post a lot on LinkedIn. We have levelvc.com. We have a blog. We publish a lot of research. I think is very unique for what we do. And then Gradient Ascent is my blog. It's not as active as it used to be, but I still try to post there once in a while.
You make me miss it. It's been a while since you've written your last one, but
yeah,
nevertheless, Albert, thank you so much. I've learned a lot. I'm sure our listeners will learn a lot as well. So until the next time.
Thank you so much. Thanks. I appreciate it.
All right. We'll see you soon, Superclusters fans. Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are two small things. One, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very, very soon. Two, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's Cosmos of Insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you on the next.